The next part that we're going to cover is about management and control of account receivables. Yeah. As I mentioned before, that account receivable is a result from a credit sales uh, to our customer. Maybe we are granting them credit for 14 days, but we need to make sure they're going to pay us within the given period. Otherwise, it will create a problem for us to run our business, maybe because of lack of cash or problem related to our cash flows. So the success or otherwise of the entity credit and collection policy can be gauged by a number of techniques, including ratio. So it's important that all matters relating to the control of credit policy and account receivable are properly organized, administered. Okay, we need to establish a strong policy relating to our credits. Yeah, how much credit we're going to give our customer, who's entitled for the credit. So all this policy must be clearly established. And what are the procedure to improve our collection? Yeah. So this is the important aspect that we should not neglect. So what is credit policy? The credit department is responsible for investigating the credit history and determining the debt paying ability of customer who apply for credit. When our customer apply for credit, we need to check their history, their records, their stability, maybe their financial, their bank statement, yeah, to ensure that they do not have any problem to pay you. If the customer is a business entity, normally the credit department will ask our customer to send their audited financial statement. If you are individual, so normally we'll ask you to send your bank statement to see your ability to pay your debt. Okay. If the customer as individual, the credit department normally asks about the current earning, current expense, outstanding debts, yeah, and look at your financial obligation, liabilities, and how they handle the this kind of customers, yeah, whether based on their experience, whether they have any problems when they have maybe poor rating customer and so on. So for example, if you want to buy a car from the bank, no, you want to buy a car, you took the loan from the bank will not 100%, will not straight away give the credit or the loan to you. There must be some mechanism, we call it as credit policy. They're asking your pay slip, your bank statement to make sure you will have sufficient cash every month, will not have any problem to pay your liability. So what is monitoring credit policy? The best measure of success or otherwise of the credit policy of business is a receipt of cash collection with normal credit term. So that is the success. Yeah, when able to collect the cash within the period of time, within the given period, that's a success for the credit department. It's essential that overdue accounts are detected early. If there is any problem, you should detect early and should come up with a procedure how to encourage payment. This may entail reminder notice, yeah, letter, phone, call, or you go visit your customer, yeah, or you contact the collection agency to make sure you get your money back. If I think every one of you still remember when we do our AK111, we have this discount and we still have 2/10 and stroke 30. That is a mechanism. We give discount to our customer if they pay their outstanding balance before we give them a discount period. For example, 2/10 means 2% discount if the payment will make within 10 days. I think you still remember that. 2/10 and 30. Are you okay with this? If you pay within 10 days, you get 2% discount. So this is the policy, the credit policy to encourage your customer, your debtors to pay within the given period, within 10 days, yeah, as soon as possible. The next one is by monitoring the aging, by performing the aging analysis, where we're going to use a method when identifying every bill, yeah, when it's supposed to be due and how long it has been due. So this is the process. Okay, we did this using Microsoft Excel before this. Calculating and analyzing appropriate ratio, we come up with ratio. Management also can use ratio to assess the performance. So among the most common ratio is receivable turnover. You want to measure how many times on average receivable balance is converted into cash during the year. So this is receivable turnover, also considered as a measure of efficiency of credit granting and collection policies. What is the formula? The second formula will be average collection period. This is average collection period. Average receivable divided by net credit sales. Okay, net credit sales or net credit sale. This is our income multiplied by 365 days. So this helps you to determine how many days, okay, on average needed to collect the money from your customer. Okay, this is average collection period. So another thing is about the internal control, how to secure, how to protect your account receivables from any manipulations or any problems. So it's important that people who maintain the account receivable should not have access to the cash receipt. So people who maintain the account receivable should not be the person who receive the cash. Why? Because if it's handled by one person, there is possibility that person who received the cash, they don't record it in their account receivable. Instead, they put the money into their pocket. Okay, and then later on, they tell you that this customer already went missing, so you're going to close that account. But the real thing happened is the clerk took the money for his or her personal use. So recording of sales return and allowances, this is another critical issue about discount allowed. The bad debt return off must be authorized by a senior officer. Okay, and all the slow paying account must be periodically reviewed. Maybe every 3 months, every 6 months, you need to review the performance of your customer. Those with a slow paying record should not be given more credit. Yeah, they should be limited. The credit amount should be limited. Okay. Sales of account receivable. Business sell their account receivable in order to realize cash to finance trading operation, provide a source of cash for other reason, minimize the cost of credit control, and disposal of account receivable is referred as the factoring of account receivable. I did mention about the promissory note. Yeah, when the customer come up with a statement that they're going to pay you on certain date, yeah, but in certain cases you don't want to wait for another 30 days. What you can do is you can factor your account receivable. Mean, for example, the document say they're going to pay you 10,000 on maybe 30th November 30th November 30th November. So this is you have this document, that your customer is going to pay you 30,000 on 30th November. Okay, you want to realize your account receivable as soon as possible. So what you can do is you can sell these paper to another person, another company. You need to sell this paper to this guy. So at price of maybe 9,000. So this guy will pay you 9,000. So you receive 9,000, and then this guy later on will get the money 10,000 from this customer. 10,000. So this is what we call as factoring. So you receive your money early, but you won't get full because you already discount it for 1,000 there. So A will pay C instead of B. B receive only 9,000. So this is what we call as factoring. Okay, disposal of account receivable. Another way is by using a credit card. A credit card enables the holder to obtain credit up to the predetermined limit from the issuer of the card for purchase of goods and services. This is very common practice. We don't borrow from the shop, but we use a credit card. Credit card means, for example, provided by the bank. Bank give you credit card, maybe $30,000 credit card. So you can shop for any goods, for any service until up to 30,000. And that the bank will pay all the seller. And you, every month you need to pay the bank. Okay, every month you need to pay the bank. If you miss the payment, they will charge you. They will charge you for outstanding balance. They will charge you for late payment, and they will charge you so many things there. So that is how bank make money. So that is another way to reduce the problem of doubtful debt. That is by encouraging customer to pay on credit. It's interest, yes. Normally the bank will give you certain date. For example, the bank will give you statement. They give you a paper. This is called as your credit card statement, maybe on 25th day every month. And they give you another 14 days to make payment. Okay. If you make full payment before the due date, you will not be charged any interest. You will not be charged any interest. If you exceed the day and if you don't make any payment, they will charge you your late payment fee. They will charge you the interest. Yeah. So, but this is not a good strategy. Yeah, financing strategy, because the interest rate of credit card is very high. So, if you don't have use the credit card for your normal purchase, but please make sure you must make the payment before the due date. Otherwise, you have to pay the interest and the late payment charges. Yeah. But if you withdraw money cash by using the credit card, you will be charged immediately. So be careful. Yeah. Try to avoid drawing cash using your credit card. Okay. Another way is by using debit card. Yes, high charges. Yeah, high charges. They will charge you immediately, not until the statement. Even they don't issue the statement automatically, they will charge you maybe 100 dirham if you not sure what's the policy of your banks. Yeah. So another way is by using a debit card. A debit card. If you have this debit card, mean your customer bank balance money will be transferred straight away to your business account. So this is a good strategy on how to reduce your account receivable. Yeah, this is what we call FPOS, electronic fund transfer point of sales. Yeah. So this is your business. This is your customer. Okay, customer. If they use FPOS, they use FPOS. Their bank, the customer bank, will transfer the money straight away to your accounts. So no account receivable needed. This is considered as cash sale as well. So FPOS services provided by merchants of such services, and they levy a variety of charges on the business, for example, a startup fee, transaction fee, and then. But you, as a company, as a seller, you have to pay certain fee here. For example, to start up for the machine, yeah, for monthly fees as well as per transaction fee. But it saves you from doubtful debt because you receive the money straight away to your bank accounts. Okay. As a conclusion, there are different types of receivables. Yeah, we have account receivable. We also have bill receivable and other receivable. So it's very important for us to value our account receivable correctly. So we want to make sure we provide a reasonable estimation on the doubtful debt as well as account for the bad debt. Another thing is, as a manager, as accountant, you should devise a good credit policy to ensure you have a minimal bad debts and doubtful debts. Thank you so much.